Both gold and silver are experiencing a correction right now. When you hit an all-time record high like 5,600, it is not unusual for there to be a steep and quick decline as it moves into a corrective phase.
Just looking at that chart, it looks to me like a classic double top formation. You have a sustained.
It is a lower high than the previous high and then a lower low than the previous low, which is why it's fairly easy in terms of explaining it through an Elliott Wave count when you consider the move, because this starts our count at 3,400. The C is a classic zigzag because the C wave is supposed to be the lowest in terms of a correction. From 120, silver moves down to 63. That's our A wave. Our B wave goes from 64, 63 up to here. Now, this move here of the B wave, if you recall, with gold, it was much closer to the highs than silver. The C wave completes a classic zigzag.
Which do you think has a higher potential of reaching new all-time highs this year, gold or silver?
I think both of them will achieve that. When we look at some charts, I'll show you why I believe that. Okay. But they're running in a very similar manner in terms of my Elliott Wave count. Both gold and silver are experiencing a correction right now. As I said, that's that ABC we talked about. Silver did the same thing, and it's also in its the primary first wave, in other words, a new part of a motive phase. What's interesting is the performance of silver during the big rally, and that's the rally we looked at on this chart from roughly August to the all-time record high. Came in 29th of January. That's precisely what we saw in silver, moving to a new all-time record high above $120 per ounce. And I would have never thought we would see it this quickly, but we did. Now we have to take that information and restructure our model to account for silver's incredible move to the upside.
Gold has, in the last 2 months since the beginning of January, or middle of January rather, it's fallen by the order of 12 to 15%, actually no, close to 20% on 2 occasions in a very short amount of time. When an asset like gold, which has traditionally been very stable in price, has this much volatility, not just once, but twice in this short amount of time, what does that tell you about the market overall?
The real story may not be the rally, but the violence suddenly appearing underneath it. As Gary Wagner points out here, both metals are still tracking a similar corrective structure even after silver surged faster than most analysts expected. A nearly 20% swing in gold twice within weeks suggests institutions may be repositioning, not simply reacting to retail fear. When a traditionally defensive asset starts behaving like a momentum trade, investors should pay closer attention to who is driving volume behind the scenes. Next, Gary Wagner discusses why that correction may be more revealing than the record highs themselves.
What does that tell you about how traders and investors are feeling? Do you think the price is broken somewhat?
No, I think that we're in an environment in which the variables that gold is sensitive to, uncertainty being number one, of course, crude oil and the dollar, but the fact that it went to an all-time record high in January, and then the best way to explain it is technically, as it fell down, was a classic A, B, C correction. And if you look at this chart, really, we had a wave one that came in July, took gold to 36.21. The wave two was a small but effective correction, 34.35. And then when we had this third wave, and that's always supposed to be the longest, we get a 3. That goes up to 4,500. Wave 4 takes it back to 4,000. And then we get a fifth wave. And then we get an extended fifth wave because typically this wouldn't repeat. But this was the near parabolic move, taking gold from about 4,400 to 5,600. When you have a market that moves up that quickly and that much, you can expect the corrections to mimic that. And that's why we saw the severe sell-off. The trouble I had at the conclusion of the fifth wave was that this A wave going from 5,600 down to 4,400 occurred over three.
Parabolic moves often create the illusion of safety right before risk expands. As Gary Wagner points out here, gold climbed from roughly 4,400 to 5,600 so quickly that a sharp reversal became statistically less surprising than many investors want to admit. Markets that rise too fast often force weak hands out just as larger money quietly reassesses exposure. The concern is not the correction itself, but the compressed speed of that first decline, because rapid liquidation can signal stress beyond ordinary technical selling. Next, Gary Wagner talks about why the timing of that drop matters as much as the size.
It's a daily chart, 3 trading days. Typically, it takes much longer than that because if you look at the B wave, there's probably 3 weeks of trading or close to a month. It concluded on March 3rd and it began really on February 26th, so about a month. And then the C wave also took some time from March 3rd down to March 23rd. So it's this A wave when there was a virtual meltdown. We saw that in gold and silver, specifically Friday the 30th, in which gold opened at 54.50 and then closed at 49 and change. That's a tremendous move in a day. It's one of the most sizable downside moves we've ever seen in gold. I believe that it holds the record for dollar moves. Percentage gains we've seen close to this, but the dollar move was ridiculous on that day. So that is not what we typically expect out of an ABC correction. 3 days for the A wave to complete with such a huge drawdown percentage-wise from where it was to where it went on the A wave. However, when you hit an all-time record high like 5,600, it is not unusual for there to be a steep and quick decline as it moves into a corrective phase.
A 3-day collapse can reveal more than months of calm trading ever will. As Gary Wagner points out here, the first leg down happened far faster than a normal corrective pattern, which can sometimes reflect forced selling rather than orderly profit-taking. When gold loses that much in a single session, portfolio managers start asking whether liquidity is thinner than advertised. March price action exposed how quickly confidence can disappear, even in assets investors call stable. Next, Gary Wagner unravels why many traders may be reading that violent move with the wrong technical lens.
I'm not a technical expert, but just looking at that chart, it looks to me like a classic double top formation. You have a sustained high volume upward move that peaked not once but twice around a similar level in a very short amount of time. And then what followed was a breakdown in support. And then now it's trading around, it's trading sideways. Does this look like a double top to you? And if so, what typically happens after a double top?
Do you mean by the double top at above 5,600 and the lower high at 54?
That one.
That to me is not a double top.
Okay.
A double top would be if the next top was close to this one. You've got a low that comes in, then you have a lower high, and then you get a lower low. So when you get an all-time record high, you get the first wave of the correction that was steep, but then when it went back up, you had a lower high, and therefore this is not a double top. It is a lower high than the previous high, and then a lower low than the previous low, which is why it's fairly easy in terms of explaining it through an Elliott Wave count. When you consider the move, because this starts our count at 3,400.
Sometimes the market shape matters less than the story investors rush to attach to it. As Gary Wagner points out here, what some traders call a double top may actually be a lower high inside a broader corrective sequence. That distinction matters because one suggests a major reversal, while the other can still fit inside a longer bullish structure. Misreading formations often causes investors to exit positions for emotional reasons instead of strategic ones. Next, Gary Wagner discusses how that lower high could change the way disciplined investors frame the next move.
And so you've got waves one, two, this is um, three, four, and then five, and then we restart to get to this primary fifth wave. That's a tremendous move in what, about not a half a year, but a long period of time, middle of August to the end of January. Moving from 34 to 56 is what, $2,200? That is a huge, huge move. Silver experienced the same kind of move in terms of percentages. And so the fact that we had the steep decline that we label as an A, this B in terms of Elliott Wave comes in structurally right on the money because it's about maybe a 65 to 70% move from the move down. The C is a classic zigzag because the C wave is supposed to be the lowest in terms of a correction. We can look at the fundamental events that occurred, and sometimes they match the standard correlations we look at, sometimes they don't. But if you look at it straight through an Elliott Wave model, and I know many have an issue with that, Elliott Wave or technical analysis, but the results are the results. It did correctly predict many things that occurred over the last 6 to 8 months.
Silver price, is it still following gold right now, or has silver started to find its own way here?
The bigger risk often appears right after a model starts looking accurate. As Gary Wagner points out here, the wave structure has tracked several major turns correctly, which is exactly when investors can become too confident in a single framework. A 65 to 70% retracement inside a volatile metal can still fit a bullish pattern while shaking out weaker hands. What matters now is whether silver continues mirroring gold or begins responding to its own industrial demand story. Next, Gary Wagner discusses whether silver is still a follower or starting to lead on its own.
Let's take a look at the silver chart.
If you look at the gold chart, now I'm going to shift to silver.
Okay.
Which I've just done. As you can see, starting about the end of October, silver's at $45. In terms of the Elliott Wave count, it concludes, and then this is also a fifth wave here. So you had that all-time record high, but the interesting thing is the move that took place during this entire rally was 165% gain. A total of $75, $76 was gained on this rally when you consider silver was at 46 and goes to 120. And just as we saw in gold, David, following that, we had a pretty steep ABC correction. So from 120, silver moves down to 63. That's our A wave. Our B wave goes from 64, 63 up to here. Now, this move here of the B wave, if you recall, with gold, it was much closer to the highs than silver. The C wave completes a classic zigzag because what you're seeing is the C wave being the lowest value of the correction and the conclusion of the correction at that low, which is why we label this as a new motive phase, meaning the count restarts, and we are, like we are in gold, in our primary first wave.
A 165% surge can attract attention, but it can also distort judgment. As Gary Wagner points out here, silver delivered a far more aggressive rally than gold, yet its correction also exposed how quickly enthusiasm can reverse once momentum fades. Moving from 120 down to 63 is not a routine pause for conservative investors watching capital preservation. That kind of reset can either mark a fresh accumulation zone or warn that volatility is becoming the dominant driver. Next, Gary Wagner shows why this new motive phase could matter more than the rally that came before it.
Can we take a look now at oil and see if oil has also broken down rather, and has broken below a support level and is now on a bearish trend?
Well, obviously, the all-time record high came in right above 119. That actually is interesting because this is being labeled as a fifth wave. Then we have our A wave That's okay. Our B wave, though, is almost at the all-time records high, so it's an extended B wave. And the C wave should conclude well below the A wave, which it currently is. And if you can see, this is a Lux Algo Elliott Wave, which is provided by TradingView, and it actually plots it. I'll look at that and see if I believe that's correct. And then when I hand draw it in, I will put in where I see variance or where it should be. But you can see this X here. And what that's saying is that's where we should see oil go to. The low today was right above that. And if that's correct, I would expect it to bottom out somewhere in this area and move back into rally mode or a primary first wave.
Oil can quietly change the message the broader market is sending. As Gary Wagner points out here, crude breaking below support while still following a corrective wave pattern suggests traders may be pricing in slower demand before headlines admit it. When a B wave nearly revisits the highs, it can confuse investors into thinking weakness has passed. Instead, that structure can sometimes hide deeper fragility underneath the surface of commodity markets. Next, Gary Wagner unravels why oil and metals may now be sending two very different signals.
So we have seen not an exact correlation. We see a really strong correlation between gold and silver. But here's where it gets interesting. Typically, if crude oil goes down, the relationship between crude oil and precious metals is lower crude oil prices diminish the possibility of inflation moving higher, because crude oil accounts for so much in terms of inflationary pressures because of the utilization. Our economies are petro economies. And so to see crude oil move down the way it has, roughly from 117 to a low of $79 today, and this is a daily chart. So we had a huge meltdown today, breaking below this support level that comes in around 87, and it's based on these bottoms here. It tells me that what we witness with oil moving lower, but gold and silver moving higher, is not what we would expect in terms of direct correlations between those two asset classes, the precious metals, specifically gold, as a safe haven. But it's not been reacting so much as a safe haven. It's been reacting more like a stock does, and that's the interesting quality of the markets we're witnessing. My belief is if everything was that cut and dry in terms of the models I present, and
That's right.
the asset moving exactly in the same way as we anticipated it, there wouldn't be much of a trading market. Trading will always keep us on our toes. Any models that we use effectively need to be proven right. In other words, lagging behind that. But we're seeing interesting inflections in gold prices in relationship to crude that we wouldn't normally expect to see. And to me, that's what makes this more interesting.
When old correlations break, markets usually reveal stress before economists do. As Gary Wagner points out here, oil falling from 117 to 79 while gold and silver stay firm challenges the standard inflation narrative many investors still rely on. If gold begins trading more like a risk asset than a defensive hedge, portfolio assumptions may need to change quickly. That disconnect can signal liquidity flows are overpowering traditional macro relationships investors once trusted.